Welcome to Ben's Market Insights. This week, the market is all over the place. Doesn't really have any direction. From a macro perspective, we see the global economy as actually in recovery mode. And AI, we don't think is a major destroyer. It's certainly a disruptor, but it's not a destroyer. So let's think about sort of the macro view. I would really be very grateful if everybody can subscribe and like on our content on YouTube and give us the thumbs up. Thank you so very much. In terms of the economic data then, so we've got small business optimism in the US increasing in expansionary mode. We've got inflation in the UK falling to levels that were way beyond those forecast, allowing for further interest rate declines. That's not what I've been kind of calling and thinking about. I felt that inflation in the UK might stay quite high. Non-farm payrolls for January in the US were better than expected, and unemployment is steadying at 4.3%, which is not far away from full employment. So that's very encouraging. We got euro rates back at their lows in terms of interest rates. Emerging markets generally in growth mode thanks to the weaker US dollar. US citizens getting outsized checks from the big beautiful bill and the tax rebates that start around now. So overall, we appear to have a growth economy, stable economy right now. And the only thing that's really spooking investors is really seems to be around AI. We've also got clearly over the weekend some news flow on tariffs. I think that there's a lot of journalistic clickbait in there. Ultimately, yes, the IEEPA issue around whether Trump can launch executive orders left, right, and center to command the tariff structure may be out of the window, but ultimately through other measures, we're probably going to be roughly at the same level, if not maybe lower, a little bit lower. But the long and short of it is really, in my view, it's a no news environment, apart from, there are parts of the US political system that at least the checks and balances are in place, putting President Trump on notice that he can't really stray incredibly far from the rails that he's in. I say incredibly because he's clearly already strayed way beyond those rails with various executive orders to date. So let's touch on this issue of AI and the disruption therein. The IGV, which is an ETF, an equity traded fund index for software, is down some 32% from their recent highs and 25% this year alone. That's almost entirely due to the AI promise of potentially creating no-code opportunities, allowing folks to replace software in their own backyard and in their garage. I don't believe that that's going to be the case, but that's the sort of view that the market seems to be adopting right now. Amazon, which is announced amongst the other big hyperscalers, big CapEx program, is down some 20% this year alone. Other examples like Take-Two in games publishing is down 25% this year on news of Google's Project Genie, again promising to be able to create professional-like games environments from your couch at home. In credit scoring, we've touched on this before, Experian and Equifax are down some 40% in a couple of months as AI is likely to replace credit scoring. We don't think that's going to be the case. So it's been very much a sell now, ask questions later mentality. Is this justified or is it creating a buying opportunity? I think that we are seeing a buying opportunity. They do come very seldomly, and I think that this is one where we are in a deep seek moment when there is a technology that looks like it's a major disruption, but actually I do think that it's actually going to be supportive of the underlying large businesses out there. Clearly there will be businesses that will be disrupted and disintermediated, but the big names that we talk about regularly, I think, remain pretty solid. So let's think about what that implies. So AI clearly requires huge compute requirement to deliver the sort of promise that investors are, one, hoping for, but also concerned about. So let's also think about the fact that hyperscalers and data center owners are essentially an oligopoly in the US and globally. The three biggest by far and away are AWS, Amazon, Azure with Microsoft, and Google data centers. So to think that they possibly will compete with each other on price basis seems to me quite laughable, quite honestly, because I think as an oligopoly, they know where their pricing structure is. So it seems unlikely to me that they would jump into a huge capex program if they didn't think they were going to make a decent return out of it. So let's kind of think about this from the perspective of history and what we've seen in the past. So Amazon's long-term return on invested capital runs at around 12% or so. So why would they risk this rate of return? Clearly, if they did no capex, they would fall behind, but not as much as I think investors feel, again, because of this tripartite play in the world of data centers globally. There are the likes of Alibaba, etc., that also are in the game, but much more concentrated in China. So we have seen this before. So AWS was first developed around 2009, the logistics build out during COVID in 2020. And in both those times, we saw an almost halving of the return on invested capital thanks to the investment that Amazon was putting in place, but then only to recover within the next 5 years. So free cash flow at Amazon in 2020 from a positive 25 billion down to a negative 15 billion in 2021, and then another negative 17 billion in 2022. By 23 and 24, free cash flow is back to positive 32 billion in each of those years. So now we think around consensus estimates that have already incorporated some big capex numbers. Free cash flow has come back down again to 7.6 billion in 25 from those highs of 32 billion because of the spend on AI. Free cash flow goes down to negative 1 billion this year, again because of that $200 billion spend. And if we assume $200 billion over each of the next 3 years, we still see free cash flow, according to consensus, back to almost 100 billion by 2029. And that would be a huge number compared to what Amazon has done in the past. So that's kind of telling me that, yes, clearly analysts and consensus could be very wrong, but it's telling me that ultimately Amazon is doing this for the benefit of shareholders further down the line with higher and higher return on invested capital. And that is not an easy thing to do when you're a business as big as an Amazon. I just use that as an example. Another way of looking at it, do we think that Microsoft Windows is going to be sort of pulled away and people invent their own Excel spreadsheets? No. But will AI, maybe it's Copilot, maybe it's something else, make Excel more efficient? More than likely. So the other idea that everybody could effectively be able to invent and create their own software platforms is, again, doesn't kind of make sense, because on the basis that software is created as an integrating platform between different businesses to be able to integrate and do business with each other. If everybody's producing their own standard, that's not going to happen. So I firmly believe that what may well happen is that software companies become more like pharmaceuticals businesses, become less the creators, but more the distribution platform, if you like, for innovation. Yes, that brings down margin. Yes, that brings down the premium, but that's already pretty much happened. So the big premium in valuation that software companies used to have against the S&P has gone. It's now trading, the IGV is trading at some 40% discount to the S&P. And that to me seems to be a little overdone. So for the bigger names in the world of software, for the hyperscalers, I think this is a great opportunity to look at picking up stock at these weakened levels. These businesses, in the words of Mark Twain, reports of my death are greatly exaggerated, certainly applies in this scenario. The S&P index is quite expensive. I'll submit to that point at 23 times forward earnings. But what seems to be going on at the moment is that there is a, if you like, sort of shuffling of the assets, and there's a broadening of the investments. And that has meant that technology has really sort of fallen behind. So what's going on here is that the marginal trader is really in command. They are effectively swapping between different sectors right now, and a lot of rotation is going on, and it's very violent rotation. I think this is an environment which creates very interesting opportunities. Don't fall for the journalistic clickbait of software is dead. This is the time to be looking at opportunities. Have a great week.